This paper is about what I think I'm not exaggerating in saying that it's probably one of the major macroeconomic questions that people are asking today. And that is, where is US inflation heading? Or if you want to be more dramatic, have we lost it? After having gained the control of inflation in the 80s and 30 years of stability, do the last few months of inflation running very high show that we have lost that stability of inflation? Now, as is an old tradition in central banking, I'm going to, and as you can see from the title, start addressing that question through a nautical analogy. If inflation, as many central banks say, is like a boat that one wants to keep near the shore, then the central bank, in controlling the sails, tries to keep that boat near the shore and inflation under control. But as central bankers repeat in speech after speech, they do not have perfect control over the boat, as the winds that right now come from the very fast recovery, the global shortage of materials, or the very expansive fiscal policy have made the inflation boat drift away from the shore and thus to the high inflation levels that we observe. Question then is the boat lost? Is inflation lost? And people have been answering this over the last few weeks, over the last few months, by either trying to decompose these elements of the wind, trying to see whether this is temporary or permanent, insofar as it's just a wave that pushed the boat afar that's about to bring it back as waves come and go, or whether this is relative versus permanent, is it a slight drift or not. What this paper is going to try to contribute is saying, well, what if we had, through murky dirty waters and scratched goggles, the ability to look under the water and see where is the anchor of the boat. If we saw that the anchor had not moved, we would gain quite a bit of confidence that the boat itself would not be drifting away, but would come back near to shore. Well, that anchor in inflation theory and empirics is inflation expectations. Not only because, much like an anchor connected by a rope to a boat, inflation can never be too far from its expectations, for after all, you cannot fool all the people all the time, but much more fundamentally, because inflation, being the change unit of account in the theory of inflation, the determinacy of inflation in the long run, is ultimately about precisely the anchor alone. And even in the short run, the insights of the Phillips curve are that the inflation expectations are one of the major, if not the major determinant of where inflation will go. So what this paper is going to try to do is, precisely when it comes to inflation, offer those scratched goggles over dirty water and try to measure where is the anchor, i.e. where are inflation expectations, and in particular, can we measure them well enough to try to ascertain whether inflation itself is going out of control or not. Note right away that much like inflation and inflation expectations cause each other, the anchor pushes the boat near it, much as the boat tries to get the anchor out of the seabed. I will not, in this paper, this is not a paper about the rope, if you want. It's not a paper about the model of how inflation expectations affect each other. It is a measurement paper. I simply want to know, where is this anchor right now under the water? Now, to do so, not right now, sorry, in general, where is it in terms of evolution of time? Now, to do so, I'm going to go back in time, of course, to the most famous case we have of when the anchor got lost, the great inflation of the 1970s. Now, even though the inflation of the 1970s is often referred to as a consequence or arising after the oil shock, I think it's pretty consensual in the literature, and certainly strikes you at the eye when you look at this picture, that inflation was already drifting away from the shore as early as 65 or certainly 67, and over stages until we finally hit the oil shock in 74. Now, looking back at both the many theories that blame this drifting and inflation at the time on bad ideas, bad measurements, bad models, and bad luck, as well as especially in reading the policymakers' speeches at the time, it is one thing that struck me in preparing this paper is how often actually expectations appear, at least to the eye of a modern student of expectations. Right away at the beginning, Chair Martin, as he was facing inflation, as inflation kept on rising, and even as he felt tremendous pressure not to raise rates, and was at the time accused of creating a credit crunch and putting in question the needed lifting of boats associated, especially with the tensions that came with the Vietnam War and desegregation, he kept on referring to inflationary psychology, some mystical being that kept on foiling his plans to keep inflation under control. You look at 68, 71, Martin would even say psychology is the main economic problem. But because it was psychology, it was always temporary, for beliefs are only fleeting. And the models and discussion at the time were about how all of a sudden the Phillips curve would be shifting because the inflation expectation will have changed. And then finally, when one looks at 71 and 74, and when changed the Fed's chair to Arthur Burns, it is interesting how his main policy control inflation was not interest rates, was not monetarism, was rather his support for wage and price controls. Why? Because he felt that wage and price controls will change the psychological environment over which wage setters and firms would set their expectations. Even though expectations kept on showing up, during this period, there was no measurement of expectations. If anything, one would say that expectations are like an add-on factor used to explain whatever was not being explained by traditional fundamentals or whatever were the theories embraced by the different people at the time. This is not to say that there wasn't some inflation expectations that was looked at by the Fed. But when it looked, well, for sure it looked at its own forecasts, the forecasts coming from the Green Book, which have published the forecast of inflation a year ahead, or even going back to the earlier, of 3 months ahead. But also, even though the NBER and the American Statistical Association started serving a set of professionals systematically only in 1969, already going much further back, journalist Joseph Livingston used to call up 40 buddies of his at banks here and there and ask them what they expect inflation to be, and was publishing it. And when it looks at that data that arguably the Fed might have been looking at the time, even though it's barely mentioned, one would say that indeed, not much of a reason to worry. There wasn't a clear, and the anchor didn't seem to be drifting all that much. And in particular, in the case of the Fed, it was quite striking how the 3-month forecast was always ahead of the 12-month forecast, reflecting a belief that all the inflation was transitory and yet kept on updating as one goes. However, there were other data that was not so looked at by the central bank. All of you, or at least most of you, will be very familiar with the Michigan Survey of Consumer Attitudes and Behavior that since 1978 has been asking people what do they expect inflation to be. And we have used that in many times in many Brookings papers to understand what is going on after 1978. Less appreciated is that that survey already existed since 1946, but simply since then it had started asking people whether they expect inflation to go up, stay the same, or fall. And that hasn't been very used, but many years ago with Greg Mankiw and Justin Wolfers, we try to say, well, at least with those answers, we could come up with some kind of estimate of what expected inflation would be. And then there's this blue line here with a lot of noise coming from the insane assumption we had to make at the time, since that was the only answers we had, that inflation was either going up, staying the same, or falling. But, and perhaps more novel to most of you, is that between 1966 and 1976, the Michigan survey asked another question. For those who said that it would increase, it asked them to by how much it would increase for the survey respondents to put it in bins. This survey, these data were used in two Brookings papers in the late 70s that actually have a few sites in the early 80s. But as soon as the 1978 quantitative questions came up, people seem to have forgotten about these data. And I have found no paper that since the mid 90s has even referred to it. This paper or this presentation, I want to resuscitate that data. Why? Because it allows me not just to calculate a mean, which again shows very little movement, but importantly, crucially, allows me to measure disagreement, second and third cross-sectional moments. And even somewhat more heroically, just plot a little bit of distributions from the histograms with the 5 points that I have in the data. And these are just some smoothed version of those histograms. And what you see is that starting at least in 1967, when the data starts, what you see is a thickening from the red to the blue line, a thickening of the red tail of distribution and a hollowing of the left tail, reflected with a increase in the standard deviation and a fall in the usual positive skew inflation adaptation distributions in the US. After 70 and towards 73, 74, then the distribution, the median shifts slowly but steadily and without fail to the right. The right tail gets even much more mass. The standard deviation really rises more, even as the skew first goes up and then goes down as so much more mass goes to the right. So if you're looking at these data in 67, 1970, you would see that clearly there was something going on with expectations. Now, the media, if you were looking at the media and looked either at answers to the Gallup poll or use right now mentions in the New York Times to inflation, you could also have seen a little bit, although more arguably, but there's another way in which you would have seen the expected inflation drifting, and that is looking at market prices. Now, there were no index bonds at the time. It was illegal to even index a bond to inflation, partly because it was because the US was in the gold standard. Moreover, in the London market, where a lot of gold was traded, you would think, well, maybe I can at least look at forward contracts on gold, in order denominated in dollars to assess market expectations. But of course, the London market, which was the main market, had massive interventions through the gold pool of the different central banks. But new also to this paper, in Zurich, there was a very active gold market. It was actually even the largest one before London overtook it in the 60s, in which gold forwards were traded with no capital control denominated in dollars. And from those one can extract, you can find these were in a very dusty book in the LSE library, were quotes from one book of what were the forward prices in the Zurich market during the 1960s. And from that one sees an expected inflation that was seriously drifting up by 1967, 68, 69. Now, let me try to combine these. I've shown you that there's some hints here. You see the disagreement, you see this expected inflation. But let me try to combine them. And to combine them, I'm going to use a parsimonious empirical model that I've used in some other work, which says that, look, we can think about household expectations as being dictated by a prior, but we know that they are biased. But we also know in models that bias tends to fall in exponential distribution with some updating rate, with a slow updating rate having to do with learning. It responds to fundamental subject to a noise with very high variance that explains why I see such a sluggish behavior of the medians. Well, at the same time, individually, it overreacts to news to these individual news that come of inflation, thus generating a cross-sectional distribution that, while biased, while sluggish in its mean, has this movement of skewness and standard deviation that is informative. At the same time, market traders are but people that start with this distribution, but that observe an extra signal, one that was well captured in the seminal work by Grossman and Stiglitz, such that given that signal, the market price itself, then the market price becomes a fixed point of the beliefs of those traders, but where, aside from reflecting the fundamentals, they also reflect noise in an omega. And finally, that the median forecast, the median survey of professionals or traders is not going to coincide with the market price, because the market price is about the marginal, whereas the median is about, well, the median. What that means is that I can use my three Michigan moments, my Zurich market price, and the Livingston survey, and back out with these 5 data inputs using this model, not just reaction, dispersion, and bias of beliefs, as well as market noise, but crucially, what the fundamental expected inflation, the rational expectations, if you want, is. And putting those there, what you see is indeed that in real time, in that data, observers could have seen inflation indeed drifting up. Why? At first, because of markets, but especially because market ticks were followed by disagreement, and finally by the sluggish movement of the medians confirming it. But now, so far, this is an n=1 paper. I looked at the past, at one episode, I said I look at the data, and perhaps I eluded myself into looking too much and wanting to see what wasn't there. So then what I did was look at the last 20 years and see, well, in which countries can I find survey data? Can I find inflation that seems to have gone far afield from shore? And thus, I can see whether similar things could be seen. And the first episode of Brazil, 2011-16, a time during which loose monetary policy, fiscal dominance, a belief that all shocks were transitory, led to an inflation prices that were rising, but which were hidden for a few years as a result of administrative control prices, such that inflation ended up staying subdued, especially when one compares administrative to free prices, until it finally shot up as administrative prices were relaxed. If one looked at professionals only, SPF equivalents, one wouldn't have seen much. But if one looked again at skewness and standard deviation, if you wanted the cross-sectional distribution, one would have seen clearly in 2011, 12, 13, 14, the shift, the loss of the anchor drifting away with a boat. Turkey, since 2018, had a very large shock with elections, an attempted coup, and a constitutional reform, and a jump up of inflation. And Turkey has the nice feature that if you want, the anchor wasn't quite as firm, things move really quickly, even within a few months. And it is striking to see that, again, when one looks at the cross-sectional survey distribution, one sees very fast, sharp movements that would clearly indicate, even as early as beginning of 2018, that the anchor was getting lost. A fourth episode, and a particularly fun one, is to look at South Africa. Why is that a fun one? Because inflation there was, at the edge of the target of 6%. That was the upper element of the interval of the target of the South African, the central bank. But South Africa was very unlucky because it suffered both from the increase in oil and commodity price in 2011 and 12, from the prolonging crisis in Europe in 2012-13, from the fact that prices of electricity were raised to solve some solvency problems of the electric regulator in 2013-14, and finally because of a terrible drought in 2014-15, all of which adverse supply shocks. Now, around 14-15, you could have asked, you got unlucky, or rather you've lost the anchor. Look at the cross-section survey. South Africa is one of the best surveys of households, more than 3,000 households, so I can estimate these institutions really well. And what you see is the anchor was never lost. The anchor was always steady, and lo and behold, we didn't get a false positive. Indeed, the luck seemed to be at play because as soon as those shocks went, inflation went back. What about in the other direction, in the US 1980s? Again, the household disagreement, even as the professionals were sluggish, even as the means could be dismissed, were showing in this case, anchoring. And finally, in my last 1 minute, minus 1 minute, all right. What about today? The question you may be asking. The professionals, yet again, as in every one of my other 5 episodes, are showing nothing, but the markets have responded quite a bit, and especially the surveys are seeing quite a dramatic increase in standard deviation and skewness as the cross-sectional distribution of expectation of households has very clearly shifted to the right, with an increase in the right tail followed by a shift in the median. Indeed, this picture does not look all that different from 1968. The US, in that parallelism, is similar to where it was in 68. Now, does that mean the anchor is lost? No, but it is drifting in the sand, and much depends on what will happen, both in terms of the winds as well as the pulse of the next 12 months. To conclude, expected inflation, if I try to make 4 points, expected inflation is not some mystical psychological variable, an add-on factor for models, simply a reflection of whatever is reality, if you want, reality plus noise as in rationalization's model, or even something to dismiss because it's just sluggish, biased, and surveys are useless. No, you can, by combining second, third moments, markets, people, you can combine all that data, combined with the model I showed you is really a summary of research of the last 20 years and how to build that model. And in doing so, through the cross-sectional survey, get signal. And with that, by looking back at history, you see that the roots of great inflation were before the oil shocks and could have been seen, but were not seen because we didn't have the theory expectations or the measurement expectations or the luck. And I gave you more episodes of measurement would have been useful, and arguably that show that now the anchor is drifting, but still early. Again, the history of the 1970s inflation showed that it was the mistakes of 69, 7, 71, including not having spotted the 68 change of the anchor that led to the inflation. We are still in time to deal with it. Thank you.
Thank you. The first discussant is Alan Blinder. Okay, we must be having some technical problems with Alan. Yuri, do you want to jump in? And then if we'll try to chase Alan down and get him set up to follow you.
Sounds good.
Okay.
Let me share my slides. All right, so first of all, thank you for inviting me to discuss this very interesting paper. It's always a pleasure to read Ricardo's papers. Obviously this research is very, very topical, very, very relevant for policy discussions. And the reason why it's obviously we have increases in inflation expectations and actual inflation, and many people draw parallels to the 1970s. Similar to the 1970s, we have a big shock. Some of this is due to supply side forces, some of this is due to demand side forces. In any case, we have massive policy response, a strong reaction from the Fed, a lot of fiscal support. And many people wonder if we're doing too much of a good thing. Maybe we overstimulate the economy, and maybe we will end up with inflation that we have not seen from the 1970s. And so at this stage, I think it's very important to draw parallels with the 1970s. And this is where Ricardo's paper is a very valuable contribution. It looks at the evolution and the role of inflation expectations in this period. And it draws very important conclusions, I think. One is that the anchoring started much earlier than many people think, what is suggested in the literature, sometime around 1967 rather than 71. All right, let's see if it works now. Ricardo also documents that there is a very interesting dynamics of inflation expectations. It builds up this inflationary pressures, perceptions, expectations. They build up very, very gradually, and then you have a sudden surprise, rapid acceleration. And I think it points to a very important conclusion here that information rigidity is a key player in this story. If you make inflation a very boring subject by keeping inflation low and stable for many, many years, nobody wants to talk about inflation, nobody pays attention to it. It's very hard to move these expectations in a consistent, systematic manner. And this contrasts sharply with credible disinflations, where you can actually lower inflation and inflation expectations pretty quickly because everybody is paying attention to what the central bank is doing. One important policy implication from this is that by keeping inflation low and stable for a long time, central bankers develop what I would call credibility or inattention capital. It basically gives them space for maneuver. They can implement aggressive monetary support without being concerned that they can start inflationary fears or anything like that in the economy. And the Fed certainly enjoys this kind of capital now. It's something to be cherished and protected. But at the same time, we should understand this as a reserve, and we should use this in times of crisis. And certainly we have a crisis now. Another thing which I really learned from this paper was that what was happening in the 70s was obviously a very complicated phenomenon. But at least in terms of inflation expectations, it was really a compounding of mistakes. We didn't have good measures, we didn't have good theories, we made a bunch of bad calls, and all of this contributed to inflation getting out of control. That's an important observation. Also, Ricardo develops a really neat leading indicator. You just need to look at the right tail of the cross-sectional distribution of inflation expectations. We look at the summary statistics of that, for example, the disagreement, and it's going to tell you a lot about what people think is going to happen with inflation. You can do this in real time. It's an invaluable tool. It seems that similar patterns apply to other countries. And in terms of inflation outlook, Ricardo argues that there is a certain degree of similarity to the 1970s, and obviously this is a source of concerns. It's a great paper. I agree with almost everything Ricardo has said. One place where I take a different position is the outlook for inflation. And let me give you my reasons why I think we're not going to have a repeat of the 1970s, why I think it's going to be an unlikely event. First, it's true, we have lots of questions about how people form inflation expectations. Alan Greenspan gave a talk at some point and he said, I don't know what inflation expectations are. This was 20 years after the Great Inflation. Ben Bernanke didn't have complete answers. Janet Yellen wanted to know more. So it seems it's about time when Jay Powell gives a major speech and says, I want to know more about inflation expectations. And there is certainly some truth to this. We don't have complete answers, but we made a ton of progress since 1970s. We have much better measurement. We have much better theories. We learned a lot since the 1970s. And so this compounding of mistakes, I think, is very unlikely to happen now. We have a lot more knowledge, a lot more data. And so we can detect this inflationary pressures much better than we could in the 1970s. That's my first reason. My second reason is that we know inflation expectations move for a variety of reasons. And as Ricardo said, disagreement is a very valuable statistic for us. There is certainly a ton of movement between mean expected inflation. This is the blue line in this chart. And this is based on the Michigan Survey of Consumers and Disagreement, the red line. The official Michigan survey starts here. Ricardo is using data from this part. And obviously, during the Great Inflation, we saw a lot of movement between disagreement and mean expectations. And, we see something like this again here when mean expectations are going up. There is a lot of disagreement, and obviously it's a source of concern. But as I said, expectations are moving for a variety of reasons. And this is certainly not the first time when we have something that looks like a repeat of the 1970s. For example, we had an inflation scare at this episode. We had inflation running up in this episode. We have, again, inflation scares in 2011, 2012. There were, people were concerned about debasing the dollar and all sorts of issues. And in the end, we didn't have inflation here. We didn't have a lot of inflation here. It wasn't a systematic issue here. Part of this is the policy response. The Fed raised interest rates here, but the Fed didn't raise interest rates here. And, we didn't have any inflation. And so this raises questions about, how reliable these leading indicators could be. Obviously, none of them is a perfect predictor, and we can have false alarms. But, what this highlights is that, we can learn something from this episode to have a more informed outlook of, what is going to happen with inflation. And to kind of get a deeper understanding of this, I think it's useful just to look at this figure, which shows the dynamics of inflation expectations in the Michigan Survey of Consumers. Again, this is the blue line, and compare it with the dynamics of the price of gasoline in the US, the black line. And you should see here that there is a ton of movement here, right? It's impossible to prove anything beyond reasonable doubt in macroeconomics. But when you see a chart like this, when you see movement at low frequencies and high frequencies, for example, here you have 1 month when gasoline prices are particularly high. This is also the months when inflation expectations in the Michigan Survey of Consumers increased by 2 percentage points, right? A huge change. Now, what we see here is that, gasoline prices, salient prices appear to be a major determinant of inflation expectations for households. This is not necessarily so for professional forecasters. This is the red line. There is some movement, especially here during this episode, but here in 2011, 2012, professionals and households had a very different take on what is going to happen with inflation. No action here, a lot of action here. Why is that? Well, potentially, they had different interpretations of persistence of shocks, saliency of prices. Clearly, households can confuse changes in relative prices with acceleration or deceleration of inflation. There is some element of that. Now, what is also interesting is that here in this episode, when the Fed did not respond, this was also the time when inflationary pressures, at least in the eyes of professional forecasters, were less clear. Here we had a really strongly expanding economy. Here we were shortly after the trough of the Great Recession. And it was very hard for professional forecasters to believe that with so much underemployment in the economy, you can have something systematic in terms of inflation, just because in the labor markets there was very little hit. Now this raises questions then about what is going to happen next to us, given what we see here. And you look at the recent dynamics of inflation expectations for households and the price of gasoline. Again, a ton of movement, very little action for professional forecasters. During the COVID crisis, again, a similar picture emerges. A big increase in the prices of gasoline, a big increase in households' expectations, very little action for professional forecasters. Now, why do we have these differences? Again, we can have different stories. One story may be that professional forecasters look at the state of the labor market. They see a lot of underemployment in the economy. We had a quick recovery in the employment to population ratio, but this is still very, very low by historical standards. We're roughly at the trough of the Great Recession. And if you have something like this, maybe professional forecasters say that it's unlikely we're going to have any kind of systematic pressure coming from the labor market. And so this inflationary pressures that we have today are largely transitory. Households take a very different position. They look at these prices going up very quickly. They say, well, if the price of gasoline is so high, maybe inflation is going to be high. Now, what is going to be the right outcome? I'm sorry, the right prediction? Who knows? We'll see it in a few years. But there is at least the possibility, I think, of repeating 2011, 2012, when professional forecasters and consumers had a different take on what is going to happen with inflation. Professionals turn out to be right. A lot depends on how much persistence we will have in the dynamics of these increases in salient prices. It seems that the outlook is not particularly good. Some projections appear to suggest that oil prices are not going to fall anytime soon, and as a result, gasoline prices are also not going to fall very much soon. But maybe households will be overestimating or less sensitive to changes in gasoline prices, and maybe this inflationary pressures will turn out to be transitory. So to summarize, it was a great lesson for us, the 1970s. It spurred a lot of research. We did a ton of work. We are not done yet. We still have questions, but I think we made a lot of progress. And so the compounding of mistakes, I think, is much, much, much less likely. Ricardo's work is great. It applies modern analysis to the 1970s. It gives new insights, new interpretation. I really like the paper. As I said, a big difference between my take of what is happening now and Ricardo's is that I'm more optimistic about inflation. Obviously, there is a lot of uncertainty in our projections, but in any case, we should be keeping a close eye on the dynamics of selling prices, gasoline, milk, rents, house prices, this kind of stuff. If these prices stay elevated, this would be one force that can anchor households' inflation expectations and put us on a very bad trajectory. So I would keep an eye on that. I'll stop here. Thank you.
Okay, thanks very much. I think that we are still trying to connect Alan Blinder, and let's hope that happens soon. But what I'm going to do is, first of all, express how much I would like to be in person soon. And second of all, I'm going to go to the discussion, to general Q&A, but then we'll revert back to Alan when he shows up. So first in line is Bob Hall.
All right, am I working?
Yes.
Oh, great. Okay, so this is a great paper. It extends this from a concern about expectations, which is just the conditional, the first moment of the conditional distribution, to the entire distribution. And I think that's a big step forward. And but on the other hand, this paper doesn't say anything about inflation today. I don't think a subject came up in Ricardo's presentation at all. Yuri did get into it in some ways, but and I think that this idea of trying to introduce an anchor, it's like ancient physics and the concept of phlogiston, but it's just a name for something. And if something surprising happens, and a million of surprising things have happened recently, like wages, supposedly sticky wages for waiters have suddenly gone up by 12%. All kinds of surprising things have happened, which seem to have nothing to do with anything being anchored and everything to do with what's going on in a particular market. Now, this is all Milton Friedman's fault. And Tom Sargent and I have a paper on the harm that that Friedman's presidential address did to macroeconomics. And it introduced all this, and it caused the creation of a phlogiston-like apparatus that tries to make something causal about this endogenous variable, the conditional distribution of another endogenous variable. But if you read the IO literature, something I do occasionally, there's nothing in the IO literature that even mentions any of these ideas about how prices are formed, and prices are formed in individual markets, and inflation is nothing more than just the first time derivative of the average of all these prices that are determined according to basically supply and demand type ideas. So it seems to me it's time to kick phlogiston out of this discussion. That's not to say, again, that it isn't interesting to consider this conditional expectation may have something to do with something, but it's not central to a theory of inflation at all.
Hello, are you waiting for me?
Okay,
I can't hear you, but I presume you can hear me. I have
my apologies. I screwed up this time. Yes, you're going.
I think I have a very different perspective on this paper. When I teach my students about inflation, I tell them, forget about 1968 to 1974. It tells you nothing that's going to be relevant to today. It tells you about bad theory. It tells you about bad policy. And that's interesting. And I focus on that. Now, the key here is that we do have better measures of inflation expectations. And I'm surprised you didn't talk about the staff's common index of inflation expectations that gives a nice weighted, optimally weighted average of market-based and survey measures. And I disagree with what you said about what the data is telling us. The data is telling us that inflation expectations are remarkably stable, just as one would expect in the new framework, when we know that we shouldn't pay this kind of attention to quasi-supply shocks as the Fed does. So I think that there are all kinds of possible outcomes for inflation going forward. I would agree. And when there are supply shocks, it makes things very difficult and challenging to see what's going to happen to inflation expectations. For example, if there's another overshoot next year, and maybe it's still temporary, well, that could definitely be a factor that could lead inflation expectations to edge upward. And that's a variable that the FOMC is incredibly sensitive to. The entire framework was all about stabilizing inflation expectations. So they would respond very, very clearly and forcefully to an unmooring.
Gerald Cohen.
Really appreciate the paper. I wanted to follow up on kind of the opposite of what Yuri was saying about inflation scares, because there's also been a number of periods, and Ricardo, I wish your chart had kind of started earlier, or you'd shown some skews in the mid-2010s when there were substantial declines in inflation expectations or leftward, shifts on the leftward skew, and you really didn't see much impact on inflation. And there was a lot of concern about, declining inflation expectations. So are you saying that there's an asymmetry in the impact of inflation expectations? Are you saying that, or just this period is different?
Okay, one more, Jason Furman, and then we will turn back to the authors for this group of questions.
So mine is similar to Larry Myers, except in a more uncertain way and more of a question. Something I've been wanting to ask Jim Stock, but I'll ask you, Ricardo, and I'll ask Jim another time if he's not too busy solving climate change, which is, how you compare it to the common inflation expectations of the Fed. As far as I can tell, the Fed's thing doesn't have any sort of logic of how it relates to inflation expectations as it matters, but only as the internal logic of what's correlated with what. That forecasters, I think, have done a dismal job this year, and in general, just sort of take the Fed at its word that it's going to do what it's going to do. And also, and this is where I've wanted to explore statistically, is the CIE, I think, is very inertial in its construction as an AR4. And so that if all expectations went up by a percentage point, I think it would take us a while before we actually saw it in that index. So just trying to understand where there's a structural break, your measure, their measure, et cetera, which there may have been.
Okay, Ricardo, do you want to take those four?
Absolutely. I'll try to be brief, though. First, on a slight, well, not disagreement, but let me qualify a little bit just on Yuri, who rightly put like an opposition between what I said. I said I didn't forecast anything about inflation, and thus agreeing with what Bob Hall said. I didn't say what was going to happen to inflation. I said let's look at data on expectations. That's all this paper does. Like Bob said, I don't look at actual inflation, look at expectations. Do you see signs that expected inflation is shifted? And in the past, when we've seen expected inflation shift this way, as that meant that either you had an aggressive monetary policy response to the Fed, or did we see, like Larry Meyer said, bad ideas, bad models, timidity or whatnot, then leading to inflation getting lost? So just to say that, meaning I'm not forecasting that inflation is going to go up. I do not want to say that at all. I want to look at this one indicator. And that leads then to the first answer to Bob, which is, hold on, all I'm doing is measuring expected inflation. Now, imagine that you take a model of rationalizations, even more, perfect foresight. You would say, well, go and if you want to set inflation, go and measure inflation. But in that model, you could also say, go and measure expected inflation. After all, the two have to be the same. Well, there's certainly no lack of people that are measuring inflation. I'm measuring expected inflation. I am, as I said at the beginning, and I think Alan was going to give me more of a hard time when he gets alive, I'm really punting on the causality. I'm not following Fried, but I'm saying I want to measure this animal here. I want to measure through the whole distribution. What does it show me? Where does it indicate? What historical parallels that it has? What does it, like Yuri well put it, does it seem like a leading indicator in some sense or not? And that is what I'm doing. Third, to Bob as well, on the link to IO, hold on, but inflation is the change in the unit of account. And everything we know about the theory of price level determination is that everything that you study in your IO class is about relative prices, but inflation is about the unit of account. And whether it's the Taylor rule, the fiscal theory, the price level, monetary or the Phillips curve, whatever is your favorite theory of inflation, it's all about expected inflation. It's all about the fact that inflation could be anything you want, whatever you expect it is, the same way that you can measure things in meters, inches, or feet. But then one becomes the unit of account, and then it becomes an extremely important to understand what expectation level filling is, even if relative prices are independent of that. Fourth, and on Larry Meyer, bad idea, we have nothing to learn from 68 and 73 because people just did the wrong things then. Well, but I think what I tried to contribute here was to say, look, one of the wrong things they did was they didn't ignore expectations data. They always assume expectations was an anchor. They look at the wrong measures of expectations. And as such, they didn't see the drift in these expectations. And they may have been one of the contributions for why bad policies were used. That's not to say that's going on now, but I think that's a valuable lesson to going now as one looks at that data. Fourth or fifth, Gerald Cohen, great question, very easy answer. I have a paper that's called The Markers That People Get from our website, which is about precisely how between 2012 and 18, there had been a drift down of inflation expectations. Now, I was very excited about that paper. It was as of a year and a half ago, because it showed a 20 basis point drift down. This is much bigger what we've seen in the last 6 months, but I completely agree that skewness and disagreement, absolutely there have been a drift down. By the way, very interesting is that in the Eurozone, the drift down was much bigger than the 20 basis points, and there you see relevant. And finally, but I don't want to take more time, just on the index of common expectations of the Fed, let me be sure. I don't want to discuss that because I want to discuss my paper. I think it's an extremely flawed measure. It mixes apples, bananas, and oranges and says, let me just run a factor model and extract common component. But there you have different maturities, you have risk premium. You're mixing basically the markets, the people, the moments. I've shown you a model on how to combine those in this paper. You can't just pick up 5 things and just add them up like a factor model says and say, what's the fact component of it? On top of it, the way the dynamic factor model is estimated on the sample of data, it's going to be assuming a set of correlations that have changed dramatically over the last 20 years in terms of the relation between these different measures. And as a result, it is imposing a structure that I think doesn't hold. So in short, I don't think the index of common expectations tells me much, or better even, tells me close to nothing. I'd rather much use my measure that you saw in this paper, or even just look at pictures of the distributions and look at that.
Okay, I believe we have Alan on the phone. Is that correct? Alan, are you there?
Dewey, can you hear me now, Jim?
Yeah, we've got you. Okay, so then Howard, you're going to run this
I don't know what
slides?
Yeah, I will give an abbreviated version. I'm very sorry. I have no idea what in the world happened. I got locked out. It was probably something I did, but I haven't a clue.
Okay,
So
glad to have you.
I'm going to go. Thanks. Howard, I'm going to start on slide 3 in the interest of getting this done as quickly as possible. I have no video, so are you there?
We're good.
Okay. So Ricardo said something before the lights went out on me about me taking them to task. I'm not really going to take him to task, but I do want to point out that an anchor, the word as a noun, is something, as he said quite clearly. A verb, to anchor, is something different, related, of course. It's about how something, in this case, inflationary expectations, get fixed or at least greatly stabilizes. Ricardo concentrates on the noun part of this. I'm not sure if the animations are writing. This is the second part of the slide. So sorry that I'm not seeing this. You there?
Yeah, we're good. So we'll just work through this. Just keep going.
Ricardo concentrates on the noun part, and as he said clearly, he's after specific numerical anchors for long-run inflationary expectations. But to me, the verb part is more important. It's all about how the central bank is supposed to achieve whatever inflation target it selects. And I apologize if some people discussed this already while I was in Neverland. Among the methods that have been used to anchor inflationary expectations are some version of pegging exchange rates. So the gold standard is one extreme. The Bretton Woods system was another, and there are others as well. The old monetarist K% rule for money growth, that was supposed to anchor inflationary expectations. Moving up to more modern things, inflation targeting or price level targeting, which I bring up because the Fed is kind of in an ersatz price level targeting regime, or either following as a literal rule, I mean religiously, the Taylor rule, which has built in a pi star. There's another way, though, that I think is relevant to the episode that, very relevant to the episode Ricardo's talking about, which doesn't have a name. I call it earned credibility. So I use the example, the Bundesbank before the ECB had very, very high credibility and stabilized inflationary expectations in Germany without doing any of the other things listed on this slide. It was just that people knew the Bundesbank was not going to let inflation go up high, and they believed that. We wound up on the Volcker standard, which was something similar to that afterward, followed by the Greenspan standard. And one way to read Ricardo's message is that there was no such thing as the Martin standard back then. And Bretton Woods, while it may have disciplined some other countries, did not really discipline the United States. So the next slide. I'm wondering if I should skip this. Let me go over this really fast. Among the important issues in deciding on how to anchor, the verb, is the feasibility of actually getting it done, and that's what killed the K% rule. The sensitivity or not to shocks, which is why a lot of people think IT regime should target headline inflation, core inflation rather than headline inflation, and the effectiveness of that regime in actually pinning down expected inflation, which the Fed became dissatisfied with and switched to, as I said, an ersatz version of price level targeting. Overarching all of this, of course, is the credibility, and that's why I mentioned the Bundesbank standard, and how to either attain it if you don't have it or retain it if you do have it, because none of these regimes are going to be credible if they're not really working. I'm going to take about a minute on this because of having lost all that time. There's two-way causation between expected inflation and actual inflation. In my view, this is an opinion, too much of modern macroeconomics ignores one of those two dimensions and just makes expected inflation the whole show. Ricardo's not quite there, but some of this paper kind of slips into that direction by trying to put everything into the inflation expectations basket. I'll skip that last bullet point and go to the next. He does mention that expected inflation does not appear to satisfy the requirements of rationality, as I think we all know. Rather, and there's language in Ricardo's paper suggesting this in a number of places, expected inflation often reacts to and follows behind actual inflation. Michigan and other popular expectations. It doesn't have to be adaptive, but some kind of lagging. Is there any compelling reason to think that workers or households or bond traders have the same view of expected inflation? Well, if you believe in rational expectations, that's an easy question to answer, and it's yes. If you believe in looking at reality, it's also an easy question to answer, and the answer is no. And there's some contrast in Ricardo's paper between, say, the Michigan survey and what you can read out of markets. Ricardo's method of looking at markets is much more complicated than just looking at the tip spread. But commonly people look at the tip spread, and right now is a great example of divergence. Ricardo's earlier paper, which is mentioned in this paper, and that's where those equations come from, invents a very ingenious way to add these apples and oranges, the public's expectations and the market's expectations. But this is what I mentioned before. I'll just read the quotation. Beyond supply shocks, this is from Ricardo's paper, page 10, the literature has offered two other factors that also contributed to the acceleration of inflation back in those years. That's the late 60s. Each is also loosely tied to expectations. Well, I guess loosely, if it's loose enough, but he's talking about Federal Reserve errors and political manipulation of the economy by Nixon and Burns. And I, for one, wouldn't stuff that into the expected inflation bucket, but look at them differently. I'll skip this in the interest of time and go to number 4 on my list. Did you catch up to me, Hao-Chen? Says yep. Ricardo's main conclusion. Okay, so this is a graph that you saw from Ricardo and his conclusion at the last page. During the U.S. great inflation, the expectations data shows a drifting anchor already between 67 and 70, and you can see that very clearly, which he notes is well before the Bretton Woods, the collapse of Bretton Woods or the oil price shocks. Notice, however, the sharp downward movement in this in 1971. So this is my last point. The question, and Ricardo answers this with an affirmative yes. Did we lose the anchor in the late 60s rather than in the early 70s? So I put up on this slide first just a chart of this 12 months change in the CPI in that period of time, well, going into 70, from 65 to 75. Here's the story that people have told about this. I click this one at a time. There was a Vietnam buildup on top of a fully employed economy, and that's a recipe for inflation. The Fed tried to fight it with the credit crunch, which I heard Ricardo mention, causing what we call then a growth recession. There are a few people in this room old enough to remember that term. We haven't needed it in recent years because we have real recessions. Then fiscal policy finally responded with a surtax in the middle of 68, price controls in 71. And what you can see in this is inflation is coming back down to 60s level, not the 50s levels for sure. And then it runs out of control. Oh yeah, I forgot Nixon Burns. I mentioned that before. So on the right-hand side of the slide, I show at the bottom just a snapshot of the years Ricardo focuses on, 67 to 71, and and right above that, Ricardo's diagram showing the loss of the anchor. And I think if you look at those two panels, you'll conclude, as I do, that allowing for timing and alignment differences, the CPI data are monthly, Ricardo's analysis is annual, they look a lot alike, quite a bit alike. So there's not so much very different despite all this tremendous amount of ingenious work that Ricardo did between this measure of the anchor Remember, the level is sort of a free variable. He doesn't necessarily need it to be 2%. And what actually happened to inflation. Last thing I want to do, even though I'm out of time, is I'm going to show you in a second the quotation you'll barely believe. As it says on the slide, Ricardo was very critical of the Fed for being insufficiently aggressive against inflation in the 66 to 68 period. But I want to remind everybody that Lyndon Johnson famously barbecued William McChesney Martin at his ranch in Texas at the end of 65, practically screaming at him not to raise rates, and yet the Fed raised rates anyway. And this was followed by a credit crunch and the growth recession that I indicated a moment ago. And finally, here's the quotation you will take away and remember. It's amazing from the perspective of 2021, or for that matter, it would have been amazing from the perspective of 1991, to say that the view that the Fed doesn't control inflation. Look what this quotation says. By the way, it comes from the February 68 economic report of the president. I'll read it with you. It has been and remains the conviction of both the administration and the Federal Reserve System. Notice that they're collaborating on the same proclamation. And that proclamation is that the nation should depend on fiscal policy, not monetary policy, to carry the main burden of the additional restraint on the growth of demand that now appears necessary. So if you're looking for some misbegotten poor theories, here is one. And I think that played a very significant role in this period of time. Thanks a lot. And again, I apologize for whatever in the world happened to the transmission.
Thanks. That was great, Alan. So we are close to time. You know what I'm going to do is we can't possibly get everybody, but if Bob Gordon and Rick Mishkin promise to be quick, I will allow you to talk. So Bob, we're going to go with you.
Okay, can you hear me?
Yes.
Okay, just a couple of points in thinking about now versus the 1970s. A big difference is that the two sources of supply shocks in 1974, the oil shock and the end of price controls, were both permanent. Oil prices went from $2 to $12 a barrel and then stayed at $12 a barrel until 5 years later when they went to $35 a barrel. That's a lot different than the current escalation of the prices of rental cars, used cars, new cars, lumber. The level of those prices is almost surely going to come down and add a negative component to inflation. So that's something very different now. The other thing that nobody's mentioned so far is that we had very widespread wage indexation in the 1970s, and that meant that the supply shocks got translated into wage behavior and then back into inflation in a vicious circle. And we don't have the same kind of wage follow through. We have independently something that Bob Hall mentioned, which is we do have labor shortages and we do have wages going up at the bottom end of the skill distribution. But again, I think that's going to be more of a level effect than something like indexation that permanently feeds through. Those are my two comments.
Thanks, Bob. That was great. Rick, really quick. Rick Mishkin there?
Oh, I'm sorry. Can you hear me now?
Yes.
Okay, sorry about that. I think that one of the key things that Ricardo does in this really terrific paper is indicate that we are at a critical juncture. And the issue is going forward is will the Fed make policy mistakes? That's what really got us into trouble. And in the 60s, it was this misestimate of what the natural rate of unemployment was. There was political influence on the Fed, and Alan Blinder's point is exactly correct as well. So I am worried that the Fed could be making policy mistakes. And the key is that these are mistakes that would affect aggregate demand, because I think the point is clear that supply shocks, we should basically work through them, but it's really demand shocks that are really problematic. And so there's one of the issues right now, which is how temporary or permanent is this inflation surge? How much is it from the demand component of very expansionary monetary policy? And how much could be due to these supply shock elements? So they could make a mistake there, just like they made a mistake in terms of what the natural rate was. Very important, I think, is the new monetary policy strategy of the Fed, which I actually am very supportive of, which is this average inflation targeting. I think it's very flawed in the actual execution, because what they've done is they said we're going to focus on the average, which allows you not to let bygones be bygones. There are many advantages to that. However, it really requires you to be transparent, in particular, just talking about what the horizon is of this average. If the horizon is infinite, you are not anchoring inflation expectations at all. And the Fed has absolutely refused to be as clear on this as they need to be. And this means that, in fact, it could actually lead to problems in terms of inflation expectations. And the other thing is that the Fed actually believes that many of the people at the Fed have made statements that the Phillips curve is dead. And I think there's a lot of reasons to say that the Phillips curve may be hibernating, not dead. And this is an area of my research, so I take the view that it's hibernating. All of those could mean that the Fed is going to be behind the curve. And I think that there's a real possibility of that. And if they get behind the curve, then we can have the kind of problems, not what happened in the 70s, because they made such huge mistakes. But once they get behind the curve, it means that inflation will go higher, expectations higher than should be. And to get it back down again, they'll have to tighten more than they should. So I do think that this is a very dangerous juncture. And I think that this paper supports that we really have to be very careful about what future policy is.
Okay, thanks. Ricardo, do you have like one or two things, or should we? Okay.
5 sentences very quickly. Bob Gordon, my paper stops. I'm really focused on the 67, 72. Everything you said is right, but that's after 72, the indexation, the oil prices. Yuri and others, have I developed this theory enough? Do we have enough measures that we can do prediction of inflation? No. And you right away point to a few data points where I can't, maybe I can't, maybe we're still pretty far from using this as a predictive power. Number 3, the 1971 price controls and that dip that Alan Blinder mentioned, very important. And again, modest, I just can't address it. But it's very interesting and very consistent with what Yuri showed, that the price controls, by attacking these salient prices, seem to have a really disproportionate effect on expectations, which is something that I hope research can explore. Why price controls are very effective on expectations? Maybe that's important, maybe not, but I think it's important. David Romer asked in the chat, can you go from here to, again, Yuri asked me about predictions. David Romer, can you go from this to tell me more about models, Phillips curves? Again, I don't think I can. And so I just need to be modest and say that I've done that. But finally, on Rick, absolutely. You said that the key is, did the Fed make errors, and the States will make them now? Well, there's one error that I hope they won't make, and that is my very, very modest contribution, which is not looking at the expectations data properly. That's what this paper tried to do.
Okay. Thanks very much. That was great.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.